Your number to watch today is this, 2872. Why? That is the record high for the S&P 500. We're about 17 points away, or 0.5% from that all-time high. Lots to talk about. Joining us on the desk today, Joe Terranova, Jim Lebenthal, Josh Brown, Stephen Weiss, and Pete Najarian. I'm kidding. That was for you, Pete. Guys, all right. Welcome. All right, so we are 0.5% away from record territory. What can drive us into that? What could derail the market? Josh Brown, please don't say more buyers than sellers.
Buybacks will help, but I'm going to give you the only two things that you really need to look at right now. But I still want you to stay around for the rest of the show. These guys probably have some interesting stuff to say as well. Number one, when you look back at the previous time we hit that peak, which was late January of this year on the S&P, two things were happening. Number one, we were extremely overbought on the basis of RSI, relative strength. We were hitting an RSI of between 80 and 90 for like 2 consecutive weeks, which is way overdone, meaning the momentum was way too strong. That is not the case right now. You're looking at an RSI of about 59.60, much more healthy to be back at those levels and not yet overbought, which means there's a lot of room to run here. The second thing I want you to focus on, percentage of stocks above the 200-day. Again, when we were hitting those peaks back in late January, it was an absurd number in the 80s. Almost every stock was in an uptrend. And that is a little bit overly bullish given the reality of the economy. Right now, more like 67, again, gives you a lot more room to run. So for those two reasons, I think when we do break out, we don't necessarily have to double top. We should see something healthy here and a little bit of follow through on that advance.
Top of the show, getting a little bit wonky.
Everyone else continue, though.
Oh, it's a little bit wonky. Let's de-wonk it just a bit here, Joe. What do you think?
Well, I think when you're looking at the indicators within the market, there's been some things that have been very favorable underneath the surface that could be very helpful in the coming weeks.
First RSI and the number of stocks above the 200-day.
We were told a couple of weeks ago that 10-year Treasury is getting above 3%. Ooh, that's a problem, Brian, for equities. Well, what has the 10-year Treasury done? It's pulled back. It's 282 right now. We were told that oil prices approaching $75. That would be problematic for the market, Brian. Oil prices sit now at $66. And then we were worried about the U.S. dollar. The U.S. dollar in the last 5 days, it's moderated that appreciation that it has actually had. It's actually pulling back a little bit. So you've got some conditions that are favorable. In John's world, you have a VIX down somewhere around 12.5. So I like seeing these internals in the marketplace. I think it sets up well. You also have, on a fundamental standpoint, you've got Jackson Hole at the end of the week. You'll get some
big Fed conference.
Big Fed conference. And then you also have the Chinese coming to Washington. I know it's a lower level discussion, but at least it is a discussion.
But what makes me nervous, I guess, John Najarian, so let's connect the dots on Joe's piece, because here's the thing. I understand the dollar's move. I understand the VIX's move, I guess, but I don't understand the bond market's move, because if the bond market is getting a bid because they're worried about Turkey or they're worried about China, why isn't the VIX responding? Why does it seem like we're de-risking at the same time the bond market is expressing a little bit of nervousness?
I think the bond market is going to end up with another short squeeze. We've seen several of them this year, Brian, and since it moves in the opposite direction of interest rates, as you know, we're going to see, I think, more of that because of issues like Turkey and other things that have percolated around the world. But last week we talked about the VIX peaking to nearly 17, the short term, the cash VIX peaking at almost 17. And we said all the bets on the table right now, virtually all of them, were against it going any higher, were instead that they would come down into this week. And come down it has. They were buying puts last week in the VIX, betting that it would come down. They were selling upside calls in the VIX. Both of those have been very good read-throughs into this week, Brian.
The mysterious they buying puts, but they are also apparently being very aggressive buying calls in the SPY, the S&P 500 ETF.
You are correct, sir. They did a big 1-by-2 spread today. They were out there buying basically at the money calls in the SPY.
What's a 1-by-2 spread?
So where they buy, for instance, I think it was 8,000 calls, sold 16,000. So 1-by-2 ratio. And they sold them up to the 97 strike. So in other words, this is somebody who's betting that we drift higher, probably not more than 4 or 5% in the relative short term in the next couple of months, but they make money all the way up till there. They put almost no money on the table because for every option they bought, they sold 2. That paid for this option. But they have upside risk if we explode to the upside.
We're going to call it the fog hat trade, slow ride.
I like it.
Right?
Fog hat.
The fog hat trade, the slow ride. Because it's not an aggressive bet. It's just kind of a safe bet.
Yep, it's a relatively safe bet if you're looking for what Josh was talking about, and that is a move to the upside, but perhaps not, hold on to your shorts. This thing's going to be a rip-roarer right here.